What common life events change a single parent's tax deductions? Imagine your life changing in ways you never expected, and suddenly your tax situation shifts too. Life events like having a new child or moving can really impact your tax deductions. When a single parent welcomes a new child through birth or adoption, they can claim that child as a dependent. This often makes you eligible for tax benefits like the child tax credit, which can be up to $2,200 per child in 2024. You also need to get a Social Security number for your child to claim these credits. If you adopt, you might qualify for an adoption tax credit, which helps offset adoption costs. Changes in custody or living arrangements are common and can change who claims the child on taxes. Usually, the parent who has the child living with them more than half the year claims the dependent. If you gain custody, you might be able to file as head of household, which offers a higher standard deduction and lower tax rates. Losing custody means you might need to switch to filing as single, which can affect your deductions and credits. Getting married or divorced also changes your tax picture. When you marry, you can file jointly with your spouse, often increasing your standard deduction and possibly lowering your tax bill. If you divorce or become legally separated before the end of the year, you might qualify to file as head of household if you meet certain criteria. This can give you a better tax rate and more deductions compared to filing as single. Your income or job status can shift your tax deductions too. If you get a raise, you might move into a higher tax bracket, so adjusting your W-4 form with your employer helps avoid owing extra taxes. Losing a job or going on unemployment benefits also impacts your income. Remember, unemployment benefits are taxable, which could affect your eligibility for certain deductions or credits. Buying or selling a home is another big life event. When you buy a home, you can itemize deductions for mortgage interest and property taxes, which can lower your taxable income. If you refinance your mortgage, you might also deduct points paid on the new loan. Selling a home can have tax implications if you make a profit, but if you lived in the house for at least 2 of the last 5 years, you might be able to exclude up to $250,000 of profit from your taxes. Childcare expenses are a common concern for single parents. Paying for daycare or after-school care can qualify you for the Child and Dependent Care Credit. This credit can cover a percentage of your childcare costs, up to a certain limit, reducing your overall tax bill. For example, if you spend up to $3,000 on childcare for one child, you might get back a portion of that as a credit. Education costs also matter. If you or your child pay for qualified education expenses, you could be eligible for credits like the American Opportunity Credit or the Lifetime Learning Credit. These can help offset tuition, books, and other related costs, which can make a big difference at tax time. To make the most of these changes, it's smart to review your filing status regularly, ensure your dependents are correctly claimed, and update your withholding if your income changes. Keep track of expenses related to your children and homeownership, and consider talking to a tax professional or using reliable tax software. Being aware of how life events influence your deductions helps you keep more of your hard-earned money. Remember, staying informed about these common life changes can make a real difference in your financial management as a single parent.